Hello and welcome to the show that discusses the hottest issues of the day. You're watching The Big Picture. After disappointing industry by keeping interest rates steady in its last meeting, the Reserve Bank of India announced some key measures to shore up investment and give a much-needed boost to the economy as a whole. These steps come after outgoing Finance Minister Pranab Mukherjee had indicated that measures to give the sagging economy a fillip were on the cards. In an effort to prop up the rupee and bring more foreign capital into the country, the RBI hiked the cap on the amount of government and corporate debt that foreign portfolio investors can buy. In another important development, financial institutions like central banks of other countries, sovereign wealth funds, and pension and insurance funds as well can now invest in buying bonds issued by the government. The new entities wanting to invest money will have to be registered, of course, with the Securities and Exchange Board of India or SEBI. In what comes as a relief for the manufacturing sector, the external commercial borrowings limit for companies has been raised from 30 billion to 40 billion overall, and that's not all. Manufacturing and infrastructure companies, as well as those that have foreign exchange earnings that want to repay a fresh rupee capital expenditure loan, can now avail of a limit of 10 billion from ECBs. But after a brief spike in the markets early morning on Monday, the proposals got a cold response from industry and markets alike, with leading voices proclaiming that these measures couldn't really deliver what they intended to do. Tonight on The Big Picture, we discuss whether these steps taken by the RBI are indeed capable of shoring up investment and halt the ever-sliding rupee. We also discuss what possible measures can the government and the RBI take in the near future to revive the economy. And joining me on The Big Picture tonight is Rajesh Mahapatra, Deputy Executive Editor of the Hindustan Times, as well as Dr. Soumyakanti Ghosh, Director of the Economic Research Cell of FICCI. Also joining us on the program will be Anjon Roy, Senior Economist, who joins us on the program as well. I'd like to start the show, however, with Rajesh, if I could. Rajesh, some people, especially market voices and leading industry voices, have said that these measures come a little late. And it's a case of too little, too late, and they're also myopic in their vision. I was talking to Soumyakanti Ghosh just before the program, and he said if you examine the small print of these measures, they're overall good measures, but industry was expecting far more. Do you think it's a case of that exactly? Industry expecting more, and that's why they got a cold response? Otherwise, they're quite sound in itself, these measures?
Expectations are built on what policymakers, governments, leaders in governments say and how they arouse expectations. I think a lot of these expectations got built over the past week when the finance minister kept talking about a few measures that could follow. One is not sure whether those were statements aimed at pepping up sentiments, or whether those were statements which do not get backed up with adequate homework, or that those were statements relating to measures that in a very strict sense do not fall into the purview of the government or the finance ministry, rather in the purview of the central bank, which in our case is an autonomous body. Right. So I think a lot of expectations got built up when the finance minister said that wait till Monday, and so people thought that something big would happen, and when that didn't happen, people were disappointed.
Right.
Having said that, too little, too late, that's how some have described it. In the context of the expectations that had got built up, probably that reaction would look justified. But the bigger question here is that even if these measures were to come in time or had come in time, how far they would have carried forward the economy.
Right.
Would they have constituted a sustainable answer to the problems that you are confronting?
Right.
Or would they have been a stopgap,
short-term solutions?
Symptomatic treatment.
Right. Let me come to Soumyakanti Ghosh for a bit. No shock and awe as people were expecting in the industry. They've by and large said, industry voices by and large have said that, and I know you differ slightly from it, they've by and large said that the merit of these proposals are sort of suspect. Voices coming in today as well. saying that this easing of limits for ECBs comes at a time when the existing limits haven't been exhausted yet. Even though one limit has been exhausted, government securities have hit the ceiling. Perhaps that's a good move. Do you think that should be a problem at all? Even if this step is taken right now in the current context, do you think that it'll eventually help getting capital into the country like the RBI hopes?
See, I mean, as Rajesh just pointed out, I think the euphoria from Saturday when the finance minister said that some packages will be announced, and the market was expecting big bang measure, which not only should have been localized measures by the RBI, but also some measures from the finance ministry. So from that point of view, it has been a disappointment. But if you go through the fine print of the document, there are actually some encouraging measures which may revive or the capital inflows into the market.
Such as?
For example, let me give a very specific example. If you look at these infrastructure bonds, it has been clearly said that the limit was 5 years. The limit has now been the lock-in period reduced to 3 years. And additionally, it has said that the residual maturity has been slashed from 5 years to 15 months. So in effect, an FII could come into the country and instead of the 5-year lock-in period, can now invest in a paper residual maturity of 15 months.
Right.
So that actually is a very encouraging step. But the important, but in case of the sovereign bonds, the disappointing is that the limit was 15 billion. And I think 14 billion has now been exhausted. So only a 5 billion incremental increase has been a disappointing from the market, given the fact that the investor base has been widened and there is a huge appetite for the sovereign debt of India.
So you're saying if the limit was increased from more than 5 billion, it probably would have helped.
Yeah, that probably could have helped, but there is a catch in over there. The RBI actually had clearly stated in an earlier monetary policy statement that it is not in favor of too much of government debt. So that's why that could have been the reason of only increasing by 5 billion. And if I come to the ECB also, that also there has been it is a good step, but for those companies which have a significant foreign exchange earning.
Right.
Here also there has been some tweaking. For example, the end use has been reduced from 75% for some companies, 60% for infrastructure companies. Now there is no restrictions. So that also is a very positive step.
Right.
So overall the steps are in the right direction, but as I say right now, it may be, maybe a wider package could have helped the market sentiments to a significant extent.
Let me get Anjon Roy in on the discussion. Mr. Roy, another criticism of these raising of the limits as well and doing that before easing FDI restriction is that depending on portfolio inflows, which have proved to be fickle and unreliable in the past as well, can actually harm the economy rather than do it any good. Critics point out the China model where they favored opening up FDI first before it eased restrictions on portfolio inflows. Would you agree with that? Would we have been better off if we had eased restrictions on FDI first and then probably concentrated on portfolio investors? Do you agree with that?
Surely, what is needed is equity investment from overseas, which is much more stable investment. What has been done by RBI or SEBI yesterday is just opening up the debt window a little wider. These are only debt funds. Now, debt is not very welcome funds. What we need is, once again, equity. Why? And more disturbingly is that the government debt is more widely being open to overseas investment. This is rather dangerous. See, we should not, as such, fiscal deficit is very large, getting large. And if we keep on getting funds from overseas, the repayment is might at times become a problem. So government debt, as has been already referred to, RBI not being very favorable to opening up government debt to overseas subscription is very right. There are very major arguments against opening up this sector to foreign investment, foreign subscription. What instead should have been done is easing up FDI in retail or raising FDI cap in sectors where there are existing low FDI caps. That kind of opening up would have been better. And that kind of flow would have showed up the exchange market also,
Right.
much more on a longer term basis.
Right. Mr. Roy, we'll come back to you in just a bit. We'll have to take a short break right now. We'll come back and talk to Rajesh about how volatile inflows can actually be fickle and can't be reliable, how cut-and-slash investors really are only making to look a quick buck rather than help the economy of a country. More on that after the short break. Keep watching The Big Picture. Welcome back. You're still watching The Big Picture, and we're discussing the steps, the measures that RBI just took yesterday to halt the slide of the rupee, as well as shore up the economy and bring back capital inflow, bring back investments into the country. Rajesh, won't these steps that RBI has taken yesterday, some would say, make us vulnerable to volatile inflows, which, as you all, like I just mentioned, cut-and-slash investors looking to make a quick buck. They come in, they see the economy is doing well, they make their quick buck and they exit. Also, wouldn't this route of not easing FDI restrictions first and then going on to portfolio investors, wouldn't that make us lose out on, say, other benefits of FDI, say, for example, ancillary industries and more jobs being created?
No, there are two issues you are raising. You are talking in terms of what is the right sequencing of moves that you make.
Would that have been better?
And before that, you spoke about whether they would make, are these measures that could prove to be, would make the Indian economy more vulnerable. I think it's too early to make any of those comments. But having said that, let's look at the merit of what is the objective of whatever we have done. The objective here, the main driving force seems to be to do something about the rupee.
Right.
Okay. Then you need to go back and find what are the reasons that are driving rupee down. In one of these earlier shows, I had mentioned that if you look at 2008, you had a much bigger impact in terms of capital flight and depletion of forex reserves. Yet the rupee didn't lose ground the way it is doing today. In a way, do you interpret that as the crisis of confidence in terms of the money that you are sitting on in terms of foreign currency assets is a lot more today in a relative sense? Perhaps. And if it is so, then it could be because that could be stemming from the fact that a large part of what makes up your $300 billion forex reserves are portfolio capital from outside.
Right.
So be it in equity, Anjon talked about debt, it really doesn't make a difference. The thing is that these are short-term portfolio capital, or these are capital that could fly out. So in a sense, therefore, if you're trying to encourage some of these flows, these measures could at best be very temporary. It could be, you have got an infection, got high fever, and you are administering paracetamol to get relief, a breather for 4 to 6 hours. But in the longer run, yes, you need to look at more sustainable inflows, wherein you need to look at how do you pep up your exports in the given scenario. You need to look at how do you continue to draw FDI into the country. And therein, I'm sorry, there's a lot of suggestions in terms of, if you do deregulate in retail sector, or you do this, as if, there is a magic wand and, there are people out there waiting and they will come in with tens of billions of dollars. No, I think what draws FDI into an economy is the inherent resilience of that economy.
Right.
So I think, there cannot be a better recipe to draw, to lure foreign investors than to look inside and make your economy more resilient.
Fair point, sir. Let me take up on that and ask Soumyakanti Ghosh. Rajesh mentioned a very, very important point. Even if RBI is taking some measures, given the fact that they want to get investors back into the country, especially FIIs, given the current global scenario, do you think FIIs will be lining up, making a beeline for India just as it is? Because their confidence will also be low. There is no guarantee that people are making a beeline for India to invest.
Let me just give you a statistics maybe to counter this one. if you look, I think before in November, December last year, if you remember, the rupee slide started from August 5 when the S&P downgraded, I mean USA. After that, the rupee was down, hit a bottom of 54.5 in this mid-December 2011.
Right.
After that, the rupee started bounced back, and it was touched around 49.6 or 7
for a brief
period in February. But that was a huge turnaround for the rupee. And please note that the portfolio capital inflows, which had almost dried up in November, December, bounced back strongly in January, February, and to some extent in March. Only after some of the announcements which came in the budget regarding those GAR and all those things, the portfolio inflows started to dry up, and in April, May there was actually outflow, and the rupee again started depreciating. And if you note carefully, we also had pointed out these factors. One of, I mean, from FICCI have pointed out is that the depreciation of the rupee is not to do with the global risk factors. It is more to do with the domestic factors, which we should look more inward in terms of getting on with some of the policy decisions which have been stuck on for a long time. And that message, that even if there is a preemptive statement is done by any of the government, the RBI, the other important thing is the RBI, the steps RBI took yesterday, it was within its domain, but liberalizing the FDI flows and the other major policy reforms has to come from the government. So until and unless we don't look inward and try to look at the structural deficiency where the economy is currently going through, I think it will be a little bit difficult and optimistic to say that the RBI can solve all the ill.
But Mr. Ghosh, you do agree that there is a danger that people, even if the RBI hopes for the best case scenario, there will be people who won't be making beelines to India. There's no guarantee of that. You do admit that?
No, I admit that, because the structural deficiencies for the economy which is currently has been facing for the last so many months has to be addressed in several sectors, and until and unless they are not addressed, I see it will be a little bit difficult for foreign investors to make a beeline.
Fair point, fair point. Anjon Roy, coming to you, sir, has the government now pushed itself into a corner by increasing the dependency on portfolio investments, which, let's face it, given our past experiences, are of a very fickle nature and have a tendency to exit at the first sign of trouble? Has the government pushed itself into a corner now?
Not really. When we opened up FII investment in the secondary market, we knew of the flip side of it. Having committed that, we are seeing that there is a kind of relationship has developed between the stock market and exchange market, where if the exchange stock market is falling because of very dominant position of FIIs, and if they don't bring incremental funds, then it goes down and the rupee also gets hit. So this is the situation currently, but it can be reversed by raising FDI flows. Now, if we talk about that nobody is lining up to invest in India, that is right. Nobody is lining up. You have got so many competitors also who are trying to attract the same investment dollar. And the point about that, the economy must be resilient to attract investment. There is no point overemphasizing this. Nobody will come into India if the economy overall is not in a good shape. Having said that, what is important is that you have to create that investor confidence also. That investor confidence have been very badly shaken because of certain policy measures.
Right.
And it is very important to look into these policy measures. Secondly, FDI can come in even if people are interested in coming into and investing in projects in India. We are not allowing them because of problems of land acquisition, problems of procedure. No schemes, no projects are taking up, are being implemented.
Right.
Infrastructure has not expanded.
Right.
So these are some of the fundamental problems which also have to be addressed.
Mr. Roy, you raise a very pertinent point about infrastructure projects. We'll come to Rajesh after the break and ask him, and I'd like to quote a minister who had said something about infrastructure projects, but that's after the break, Rajesh. Don't go anywhere. More on the big picture after this small breather. Welcome back. You're still watching The Big Picture. Rajesh, immediately after S&P downgraded India's status as an investment destination, our minister, Ashwani Kumar, had come out with a statement and said that, look, India is not down, it's not out at all. We have immense amounts of infrastructure projects lined up, and that will help bring the country back towards an even keel economy-wise, and that will help get investment back into the country. Now, but the problem, Rajesh, is not having infrastructure projects, it's the problem that it doesn't take off. They don't take off on time, the implementation. Wouldn't you agree that the government should be moving towards removing those policy hurdles that prevent these infra projects to take off and get investment in?
I think when they talk about policy paralysis and how it is affecting, I think this is one segment which probably could have become the main victim. And I know earlier once I said that when the government doesn't do anything, then the economy does well.
Exactly.
But you know, we are in the profession of changing stances. So, so I could say that if there is any area of intervention that the government can make, and where it can make a very sustainable intervention, it could be probably infrastructure. Right. I mean, I don't track this sector as closely as probably Soumya does or you do, but my sense is that there could be myriad issues. You know, in some cases they could be just getting held up because there is no action from the administrative ministry. Right. Files might be getting stuck. You know, the whole thing. You know, right. We know that in certain
Rajesh, before we go on to another question, I'd like to ask you one more question before I go to Soumyakanti. Now, top policy makers, I would like to name them, have been hinting at more steps coming our way that the government might take. One of those steps, of course, there is talk of a proposal on financing oil imports, giving cash directly to oil companies directly. There's also a proposal of raising non-resident Indian bonds, NRI bonds, for example. Do you think these steps, if taken, will be effective in stemming, first of all, the rupee slide, and then, of course, giving the boost needed to the economy? Do you think these proposals being considered are the right way to go?
I think these are some of the many options that are available. Resurgent India bonds, you know, when they were launched, I think more than a decade ago now, they did help the economy. I think, you know, stabilizing rupee, rather, you know, recovering some of the lost ground is a very critical objective. Right. Now we must attain, because, you know, you are because the rupee is going down, you are losing out on the benefit that could come your way from a easing of commodity prices in the global market. You know, today we are battling high oil prices at home, but look at it, the oil prices are down now to $80 a barrel, but we can't do anything because all of that has got neutralized by a devalued rupee, and the same would apply in many other cases. So I think yes, anything that can be done to stabilize rupee and maybe, you know,
is a welcome
pull
step.
it back. Yeah. I think it won't be one or two measures. It could be a set of multiple measures, and from different quarters.
Right. Dr. Ghosh, let me ask you the same question. These two proposals that are in the media right now, Professor Dr. Rangarajan, of course, has hinted that the government is working on those proposals. Now, do you think these are the right way to go? Do you agree with Rajesh that these might just be helpful in stopping the rupee slide?
See, I think this dollar sale directly to these oil marketing companies, this was done in 2008, and this could be a very positive step. But regarding the RIB bonds also, even though I am strongly in favor of an RIB bonds at this point of time, but I think why the government or the RBI is hesitating is the exchange rate risk. Because currently, if it is repatriable, that who will going to take the exchange rate risk? Last time in 1998, when the SBI launched the India Millennium Bonds, the exchange rate risk was, and that is the greatest risk at this point of time, and that I think that so there is the hesitation. Otherwise, IMD or an RIB bonds at this point of time would have been an icing on the cake. Right. And there I think the message should have gone clearly from the RBI yesterday, that when he has raised the limit from 5 billion in corporate bonds, that this could be a substitute for the RIB, and that's why I believe that the limit, if the limit say was increased by around 10 to 15 billion more, that could have been an ideal substitute for this RIB or the IMD deposits which we are talking today.
Right. Anjon Roy, let me ask you this. Of course, these two proposals being bandied about in the media as well today. Papers had carried perhaps these proposals might go through. Any other steps that you think the government should perhaps take a look at, including these two steps, selling dollars directly to the oil companies as well as the resurgent India bonds? Any other steps that you might suggest or that the government should look into that would help, in fact, stem the fall of the rupee as well as revive the economy like the way North Bloc or the PMO wants it? What would you suggest?
See, we have a huge energy import bill. Our oil import bill itself is $155 billion. Our gold imports are topping $55 billion, $60 billion. And we are, although we are a major coal reserve country, we are importing coal. The 12th plan is planning to for import of 250 million tons of coal by the end of the terminal year. Now, if you have this kind of huge imports, our trade deficit this year was $185 billion. Now, these will get reflected in the rupee exchange rate. You cannot avoid it. Where do you get the dollars to import so much of stuff which in excess of our exports? So you have to fundamentally either raise your exports or cut down, pare some of these imports. Now, gold import is a totally irrelevant waste of money. We are sending out our foreign exchange, our savings outside the country. Measures should be taken to discourage gold imports. Also, oil conservation is very important, and we must develop coal industry within the country rather than planning for coal imports. These are some of the fundamental requirements.
Right.
As for the other things that we can do is concentrate on infrastructure. We should also open up the insurance sector, bring about some of the reforms in banking, and open up the pension funds. These will bring in funds, all right, but we have to do certain fundamental corrections in the economy as well.
Right, right. Thank you so much, Dr. Roy, for joining us on the show. I must thank all my other guests as well. Rajesh Mahapatra, thank you so much for joining us on The Big Picture. Dr. Soumyakanti Ghosh, thank you again for coming on the show. Of course, a lot more that the industry requires, needs and expects from the government as well. The government also will have to occupy its headspace, of course, with taking care of the fiscal deficit, which is, of course, important. Two other proposals that Dr. Rangarajan has mentioned that might be considered for the future, of course, selling dollars directly to oil companies as well as resurgent India, non-resident Indian bonds as well. That's all the time, of course, we have from The Big Picture tonight. Till next time when we get you another issue, another hot topic and another eminent panel. Thank you, goodbye, and thanks for watching.